Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and if you're new to this channel, then you can subscribe us by clicking the bell icon. Today we have a topic that is interim reporting. Interim reporting is sort of a reporting where the reporting is done at the middle of the year, probably in Q1, Q2, Q3, or Q4. It may be in any time span, as you have this has been mentioned in the extract over here of Container Ship PLC, the Q3 2018 interim reports. So interim means, in between of the annual reports, what sort of meetings that I've been setting up. So let's understand this in a detailed format. If you see, an interim report is basically, financial statement that has been reported by a firm for a period which is, you can say, less than a year, right? And they are used to convey the financial performance of the company semi-annually basis, maybe on the quarterly or even on the monthly basis. And although regulators they prescribe an annual reporting of the data, it helps in establishing a better, you can say that, and transparent communication with investors by providing an updated information between annual reporting periods. So they are normally what we call as reviewed by the company's internal auditors rather than going for complete statutory audit, which would be impractical and highly time consuming. I mean, considering the frequency with which the reports have been published. Right. Let me now give you an example of interim reporting's how exactly it works through. See, interim reports are declared at various time period. We all know now, and they are providing the evidence about the what we call as the firm's performance, right, at different intervals during the accounting period. So let's see a reporting example. Let's say a public listed company come up with quarterly financial numbers. Let's say they come up with this, and there is a real estate firms that come up with the numbers on project basis, as in when their projects are completed. So an interim financial report, it implicitly provides an important analytical information. Let me give you data of an IT company. As you move here, we will get the data over here of an IT company, the financial performances, the fiscal years. We have growth, quarter ending details, and quarter ending of 2018, 2017 detail. So even though the operating profit has risen over the year on the year on a year basis, there has been a drop in the, we can say, the quarterly numbers. So this suggests that Q4 over here was not good enough for the firm, even though there was a 12%, as you can see, growth, the increase in the profit on the annual basis. So the information implicitly signifies, the seasonality of the IT business in the what we call as October to December quarter, and this should guide the management in planning for their long-term strategic initiatives. Okay. Now let me take you what exactly are the objectives behind going for interim reporting. Okay, see, the investment decisions are taken around the year. Okay, investors don't wait for what we call as annual reports. They don't wait for this, and that are declared at the end of the fiscal year. Now, with companies relying not only on the organic but also on the inorganic growths, the annual data is insufficient in evaluating developments and earning projections of the industry and the firm. So, in such a dynamic business environment, interim reports offer a better periodic snapshot to the shareholders, and providing a current information will always keep a firm in the good books of the investors, making allocation of capital investment easy, leading to a better market liquidity, which is actually the primary goal of what we call as capital markets. Okay. Now there are major objectives. Let me run you through of this. It is estimation of the annual earnings that is based on interim of financial. Second is make cash flow projections. Third is identify the turning points in the firm's financial status. Fourth is, you need to evaluate the management performances. Fifth one, to formulate the internal control procedures. That's going to be part of this. And finally, the sixth one, to supplement the annual report. That's going to be the next thing. So these are some of the objectives of interim reporting. Let me run you through some of the advantages of interim reporting. First, interim reporting helps in establishing a better, you can say, connect with the investors. Interim report is very useful or highly useful for big conglomerates like Warren Buffett's Hathaway, that are running multiple lines of business, helping them in tracking if their short-term investment initiatives are in line with the long-term strategy. Third, if there are any material misstatement, that's what we call as error or frauds in the financial statement, it can be detected and prevented at a very early stage, compared to the annual report. Fourth, it helps in the implementation of the comprehensive internal control procedures. So that is one part of it, which further makes accounting policies very robust. Declaration of the interim dividend is possible when the fin statement, that is the financial statement, are reported for small periodic, incentivizing the shareholders to hold their investments. But there are some challenges that push down this kind of advantages. They are, although interim announcement, they reduces the interim reporting period, it increases the what we call as the impact of errors. Okay, it increases the impact of the errors in estimating or estimation, or leading to concern in reporting the accurate information. So there are various operating expenses that are incurred in one period, and the benefits are earned in the subsequent period, like advertising, repairs, maintenance cost, and such expenses. It can distort the financial status of the firm for an interim period, and although in the longer term might be, it's quite helpful. Now, the impact of what we called as the seasonality and economic cycles. What exactly happens is that is felt more in the interim statement and are almost nullified in the annual report. So they are also more prone to management manipulations by presenting strong quarterly growth in the early and the ending quarter. So this affects the what we call as the consistency and comparability of the financial reports. Third one, inventory is the main element of the revenue generation in any business. So periodic calculations, you can say that it is of inventory, in interim period, are repetitive, time consuming, and the error prone. But determination of the quantity of the inventory and its valuation leads to unnecessary adjustments in the interim financial statements compared to an annual report. The absence of a regulatory framework, what exactly goes in over there for disclosure practices, in this leads to confusion as to what extent they should be provided. So the disclosure can differ from two companies within the same sector, which can be misleading to the shareholders. Fifth, interim reports, they create overemphasize on what we call as the short-term results, sometimes presenting a distorted picture, which can be detrimental for both the investors and companies. So, on a concluding note, interim reporting is not much different from the annual reporting in terms of the content, but only differs in the what we call as timing of the publication. So, in fact, it is the subset of the annual reporting that provides all the major financial data like revenue, income, expenditures, losses. So for a particular period of time, it is not mandatory for a firm to publish it, but doing so, we can very beneficial for to the firm, for the investors and stakeholders, leading to a better and mature economic ecosystem. So that's it for this particular topic. If you have learned and liked the video, if you think that if you have enjoyed and learned watching this video, please like, comment on this video and subscribe to our channel for all the latest updates. Thank you everyone. Cheers.